Okay, so let's dive in. You brought us this really interesting academic study today.
Yeah, that's right. It's by Victor Sperandeo, and it's titled The DAIM Portfolio.
The DAIM portfolio, okay?
Okay.
And it digs into a particular investment strategy.
Exactly. DAIM stands for a Diversified Algorithmic Income Methodology. And, the study presents it as being really built on the foundations Harry Markowitz laid out.
Markowitz, modern portfolio theory, right?
That's the one, his original vision.
So our mission here is to really unpack this study, understand how this DAME thing is designed.
Hmm.
Look at its history, its performance back to, what, 1961?
Yeah, goes way back.
And see how it tries to give investors that smoother ride Markowitz talked about, especially compared to maybe more standard approaches.
And what's really striking right from the start is the stated goal. It's not primarily about, say, beating the S&P 500 return.
Oh, interesting. So what is the main focus then?
Risk reduction, low drawdowns, acting as a hedge. That seems to be the absolute core design principle here.
Okay. And the study makes a pretty bold claim about how they got there, doesn't it? Something about no data mining.
Yeah, exactly. No data mining, no optimization, no curve fitting, no hindsight bias. That's what they stayed up front. Instead, they claim the rules come from, over 100 years of research into how different assets actually behave together in, well, all sorts of market conditions.
That is a bold claim, setting a high bar for robustness.
It is, and it ties straight back to Markowitz. His whole idea wasn't just return, return, return.
Right, it was about efficiency, adding things that don't just move up and down with stocks, trying to smooth out the bumps.
Exactly, get that smoother ride. And for ages, the kind of standard Wall Street answer to that, before CTAs were really a big thing.
CTAs, commodity trading advisors.
Yeah. Before them, the go-to was often the 60-40 portfolio, 60% stocks, 40% bonds.
The classic balanced approach.
Right. But this study argues the DAME strategy pushes Markowitz's idea further. It doesn't just stop at stocks and bonds.
Okay, so it uses a wider range of things.
Yeah.
And it's algorithmic.
That's the idea. A diversified algorithmic income methodology. The name itself hints at it.
Rules-based, consistent?
Supposedly 100% rules-based. And again, that big emphasis on not curve fitting.
Can you explain that a bit more? Why is avoiding curve fitting so important here?
Sure. Curve fitting is basically when you tweak your strategy's rules so much that it looks almost perfect on the historical data you tested it on.
Okay.
The danger is you've just fit the noise and specific quirks of the past, and it might completely fall apart when you run it live in the future because the future is never exactly like the past.
Ah, I see. So by not curve fitting, they're aiming for rules that work more generally across different times.
Yeah.
More robust, less fragile.
That's the claim. Robustness over just looking good in the rearview mirror.
Got it. And the assets it uses, they change over the study period.
Yeah, the study simulates the early period, 61 to 92, using spot asset data, actual assets.
Okay.
Then from 93 onwards, the simulation and later the real performance switches to using futures contracts, specifically 27 U.S. listed, very liquid ones.
And the strategies inside DAME are described as being like CTAs.
Correct. Like systematic, often trend-following strategies you see from commodity trading advisors. The paper mentions specific internal strategies, DTI, CTI, FTI.
And it specifically doesn't trade stock index futures.
Right. Deliberately excluded. The design goal mentioned is to provide a hedge in both inflationary times and deflationary times.
Okay, design philosophy, assets, methodology. Let's get to the numbers. How did it actually perform historically, according to the study, starting with that early period 61 to 92?
Right, 32 years, simulated spot assets. The DAIM portfolio showed a 9.23% gross compounded return.
Okay, and how did the S&P 500 do in that same stretch?
A bit higher, actually, 10.66%.
So slightly lower return for DAME,
Yeah.
but you said the goal wasn't pure return.
Exactly. Now look at the risk. The standard deviation for DAIM was just 5.1%.
5.1%, that sounds incredibly low for that long a period. Standard deviation measures volatility, right? How much the returns jump around.
Precisely. Super stable. And the maximum drawdown, the biggest drop from a peak, was only 6.54% for DAIM over 32 years.
Wow. Just 6.5% max loss. What was the worst single 12-month period?
Even less, minus 3.12%.
Okay, now compare that to the S&P 500 over the same time.
Big difference. S&P's standard deviation was almost 15%, 14.98%, max drawdown. A huge minus 42.63%.
42%, and its worst 12 months.
Minus 38.93%.
So yeah, the S&P gave a bit more return, but you had to endure potential losses that were just vastly, vastly larger. 6 times deeper drawdown for the S&P.
That's the core argument from this period in the study. Dramatically less risk, dramatically less volatility, that smoother ride in action.
And it was consistent. How many losing years did DAIM have back then?
According to the study, just one. Minus 1.24% in 1969. That's it for 32 years.
Incredible. The rolling 12-month win rates must reflect that, too.
They do. DAIM at 96.51%, S&P much lower at 75.34%.
Okay, then things shift. From 1993, it moves to futures contracts.
Right. Still simulated results using futures data up until April 2021. But then from that point, the study uses published daily performance, which they consider real P&L.
And how does it look in the more recent era, say from 2004 onwards, using these futures?
From 2004, the DAIM gross return is presented as plus 5.39%. But look at the risk stats again. Standard deviation gets even lower, just 4.37%.
Even lower. Wow.
Max drawdown is negative 7.43%. Worst 12-month loss, negative 6.84%. Still very contained.
And how does that stack up against, say, bonds in that period? Bonds are usually the go-to for stability.
Good comparison. The study uses the Bloomberg Aggregate Bond Index, the AGG. Over that same period, AGG returned 3.18%.
Okay, so DAIM's return was higher than bonds. What about risk?
AGG's win ratio was 78.69%, lower than DAIM's 93.88%, and the AGG's maximum drawdown was much larger, minus 17.18%.
Wait, so in this more recent period, DAIM had a higher return than the main bond index and significantly lower volatility and drawdown.
According to these numbers, yes. That's quite a finding. It suggests that this kind of diversification, beyond just stocks and bonds, might actually offer more stability than bonds themselves in certain market regimes.
That really challenges the traditional 60-40 view, doesn't it?
It certainly offers a different perspective on where to find portfolio stability.
The study also contextualizes the very recent past, right? The S&P 500's huge run since the financial crisis.
Yeah, it acknowledges the S&P's strong plus 14.63% compounded return from 2009 to 2024, which is well above its long-term average.
And contrasts that with commodities.
Right, noting that broad commodity indexes had much lower returns in that specific period. Equal weight at plus 4.72%, GSCI plus 2.88%, BCI barely positive at plus 0.11%.
And there's a point about commodities tracking inflation but also anticipating Fed moves?
Yeah, the study mentions that relationship generally moving with CPI, but also potentially reacting ahead of Fed policy changes.
But cutting through all the different periods, the main story the study keeps coming back to is risk, correlation, and those drawdowns.
Absolutely, that's the headline. The low standard deviation, the really small drawdowns across decades. It's all designed, apparently, for a near negligible risk profile in comparison to equities.
They even mention margin requirements as a sort of external validation of low risk.
Yeah, that was an interesting point. They estimate needing only about $3.5 million in margin for a $100 million notional futures position in DAIM.
Notional being the total value controlled, margin being the deposit needed.
Right. The tiny margin requirement suggests the banks and brokers providing leverage see the strategy itself as having very low day-to-day volatility and risk. It's not advice on leverage, just an indicator of perceived risk.
And the correlation aspect is critical for its hedging role. How does it relate to the S&P 500?
The study describes it as non-correlated in the short term, but actually negatively correlated over the intermediate and long term, meaning over time, it tends to move inversely to the stock market.
And there's a really powerful statistic illustrating that, isn't there? About years when the S&P declined.
Yeah, this one stands out. Over the 64 years, from 1961 to 2024, the S&P 500 finished the year down 14 times.
Okay.
In those 14 down years for the S&P, how many times did the DAIM portfolio also finish the year down?
Based on the negative correlation, maybe not many.
Only once.
Once. In 64 years, they only went down together in the same calendar year one time.
According to the study's data, yes, just one.
There's a serious disconnect from equity market direction. Which year was that?
2022, which perfectly illustrates the hedge.
Right. 2022 was rough for stocks. S&P was down, what, 18%?
Minus 18.11% for the S&P 500. And DAIM, it was down too, but only minus 4.51%.
Huge difference. Still down, but massively buffered the loss compared to stocks.
Exactly. And that 2022 loss, along with a tiny Natchez 0.96% dip in 2015, are apparently the only annual losses for DAIM shown in the data from 1993 through 2024.
She's 2 losing years in about 3 decades.
That's what the study presents. It really hammers home that focus on capital preservation and smoothing the ride, even if you miss some of the extreme upside of a raging bull market in stocks.
Okay, one last practical point. How does someone actually access this? The study mentions the firm, EAM Partners.
Right, Victor Sperandio's firm. They clarify that EAM develops the strategies but doesn't, like, manage money directly for individuals or sell these as standalone funds
So how are they offered?
through other institutions. The study mentions banks and insurance companies embedding the strategies into products like 100% principal protected notes or using them within annuities.
Got it. So it's access via structured products or insurance wrappers.
Seems to be the main route described.
Okay, so let's try to wrap this up. We've looked at this DAIM strategy study.
Mm-hmm.
It's presented as rooted in Markovits, but using a rules-based algorithmic approach across futures, not just stocks and bonds.
Mm-hmm.
The historical performance, going way back, consistently shows really low-risk metrics, low volatility, very small drawdowns.
Yeah, remarkably so.
And it acts as a non-correlated or even negatively correlated hedge against stocks. Delivered that smoother ride, maybe not always matching peak S&P returns, but significantly outperforming bonds on a risk-adjusted basis recently.
I think what this study really lays out for you, the listener, is a tangible example of a different portfolio construction philosophy. It's one that seems laser-focused on stability and managing risk, maybe more than just chasing the highest possible number on a volatile benchmark.
It shows how adding genuinely different non-correlated assets with a disciplined approach might fundamentally change how a portfolio behaves, especially during tough times.
Right. It offers a concrete picture of those hedging benefits.
Which leaves us with a final thought based on everything this study presents. Given DAIM's demonstrated multi-decade track record of slashing volatility and drawdowns, and even beating bonds with lower risk lately, does this make you question the common obsession with simply trying to track or slightly outperform something as volatile as the S&P 500?
Yeah, it poses the question, could focusing intently on minimizing risk and volatility, achieving that smoother ride Markovits originally aimed for, actually be a more valuable, maybe even a more rational long-term goal for many investors than just maximizing exposure to equity market swings? Something to think about.